This is the London FinTech Podcast, brought to you by your host, Mike Ballerman, bridging the worlds of suits and t-shirts, of finance and technology, bringing you insights, stories, and inspiration from the golden age of opportunity and innovation happening in London right now.
Hi, this is Mike Ballerman, and this is London FinTech Podcast, episode 28. And I'm delighted to welcome on the show today David Stevenson, journalist extraordinaire and Übergruppenführer of the alt-fi empire that spans conferences, news, and as we heard in LFP028 with Rupert Taylor, Chief Executive of alt-fi Data, the data side of things. David joins us on the show today to talk about what alternative finance is in the context of a new asset class, of which he has seen and documented many over the decades. Apart from his alt-fi hats, David is an experienced investment commentator and writer in the media, technology and investment spaces. He writes for a number of leading publications, including the Adventurous Investor column in the Financial Times, Investors Chronicle, Money Week, and trade newspaper Investment Week, where he's the contrarian columnist. Contrarian sounds good. I'll have to disagree with him and see how that goes down. He's also currently launching a hardcore/academic Journal of Disruptive Finance. He's authored a number of books on investment, as well as having extensive interests in the traditional media world. All of these diverse activities no doubt help to explain why he's pretty poor at answering emails, either that or it's his advanced age. In a world of excessive media narratives around fintech in general, alt-fi Data is one of the few really hardcore providers of that rarest of thing in a hyped-up gold rush scene, facts. alt-fi Data now provide P2P and crowdfunding volume indices for the UK and Europe, along with return indices for P2P and a financial disruptors index. You can also download the full portfolios of the major P2Ps from the website. They have clearly been busy over the past 6 months. Anyway, as David told me when we were lining up the show, he's a media professional. I always wonder why I have people better than qualified than me on this show. Well, no pressure then, David. Maybe I'll leave this episode au naturel in post-production so listeners can appreciate your mellifluous tones and free verbiage. Plenty to talk about, so let's get on with the show. Hi, David. Thanks for joining me today.
Pleasure.
That's a very long introduction, isn't it?
Yeah.
It's the example of your media skill in action already.
No ums and ahs in there.
No ums and ahs, exactly. And you confound your interrogator because it wasn't expecting one word. You've taught me something already. So just to fight back, we've all heard of portfolio careers, but you seem to have set a world record in terms of how widely you can diversify a portfolio career. How did this actually come about? Couldn't you get a proper job at one desk doing the same boring thing day in, day out?
Well, I did it for ages and ages. I was at the BBC for yonks and yonks in the business department and science department, and I had my own desk. And I actually recently confided to one of my colleagues at alt-fi that I hadn't actually had my own desk for about 18 years because I had my own desk at the BBC for about 15 years and did the rising for the ranks rubbish and realised desks were not for me, I'm afraid, Mike. I'm not very good with desks. Right. I'm not very good at responding to emails, which I think you referred to earlier on. I'm not very good at those kind of things, and I realised that I was a bit too curious. One of the things I was briefly at the BBC, I did a lot of investigative kind of reporting and producing, and the problem was that there weren't many things to investigate really because people don't have the budgets for that kind of stuff. So I just got curious about other things really, and one of the things I got very curious about was investment, and I kept meeting all these big investors who were fabulously successful and seemed to drive really, really big cars. And I tried to work out what is it that made a successful investor, and that sort of got me on the old investment trail. And I got interested in investment, and it's from that many, many years later, when I started writing kind of professionally about investment, I started getting more and more interested in things like alternative finance, actually, which we'll come to a bit later. But actually, I've always been very interested in alternative stuff, mainly because as I got more interested in investment, I realised that although I could speak the language of the people with the power dressing suits in the city and all that kind of stuff, because of my economics background, and my shirts, for instance, you've probably seen them, are very multicoloured and floral. I'm not very like them, but I could talk their language.
For listeners to the show who don't have the video, because none of us do, David is currently dressed in a very James May-like shirt.
Absolutely. Never liked the consensus in investment, which seemed to be, when I first started writing about investment back in the 1990s, trust some old duffer who's been at it for 30 years to know what to do with your portfolio. And then that transmuted into hedge funds, which I'm sure we'll mention later on, which seems to consist of young duffers in slightly more edgy clothes telling, we know what to do with your money. And I certainly realised it was all basically a bit of a con, really, because I didn't really know what to do with your money at all, except take fees.
Indeed, the emperor doesn't have many clothes.
Although if you're a wealth manager, they probably have quite a nice clothes, actually.
Well, going back to one of your organs, the Financial Times today had on the first page that the top 25 hedge fund managers in the States took home $12 billion between them.
Is that all?
In a year.
Very reasonable.
Exactly.
For their
in a
combined
year.
skill base.
In a year when hedge funds returned 3% on average.
Yeah, although I think, to be fair, to some of those guys, they've probably done a little bit better than that, maybe 3.5, 3 and 3.
Some of them did, but I mean, the other statistic I recall is that I think it was last year, the top 3 or the top 4 hedge fund managers in the States took away more money than every primary school in America put together. Anyway, it's one way of running a society, and certainly the UK is the first in the queue to copy that. So we do have this winner-takes-all society, which definitely comes into hedge fund remuneration, as you mentioned, and will come into alternative finance as well, where everything tends towards an oligopoly. So in terms of the context that you're situating alternative finance in, David, at your fascinating AltFi conference earlier this year, you made an aside on stage, which I thought was one of the more interesting remarks, because there aren't that many people in the alternative finance team with enough background to contextualise what's going on, which is that you have in the past seen a whole range of stuff crop up and be alternative something, be incredibly hyped, do apparently incredibly well, and then before you know it, end up providing a better standard of living for the fund manager than it does for the investor.
That's quite unique. I never heard of that before. I mean, so over the last 20 years, as I've started writing about investment, I mean, you could just do the main kind of news beats as a journalist writing about investment. You know, X PLC's just taken over another PLC, how interesting, yawn, yawn, yawn. Or you could go and hunt down the adventurous stuff, which I always thought was interesting, or the alternative stuff, which I've always been more drawn to. And so, going back to a favourite subject we just mentioned about those fabulously talented people, the hedge fund managers, I was always very interested in alternative alpha, as it's called. You know, this alpha being the outperformance of this fund manager. As you discover it, actually, that alternative alpha is not alternative and it's not alpha, i.e. they are actually really just stock pickers, and they're not quite often very good stock pickers over a cycle, over a long period of time.
As listeners to the show will have heard me moan many times in the past, having run a fund management business on the fixed interest side and actually managed to outperform significantly for a number of years, I was surrounded by equity crowds and they didn't outperform.
Yeah.
And the other thing that does my head in, a couple of weeks ago, the London Financial News had a Asset Management Fintech conference in the afternoon.
Probably quite interesting.
Probably quite interesting. One of the most interesting aspects was that Nutmeg, Nick, was on stage bemoaning the fact there isn't any competition for him whatsoever. There isn't much in the sector was one of the interesting takeaways.
A couple of smaller outfits, much smaller.
Exactly, so there isn't really much going on there actually.
It's interesting you say that, because actually you talked a bit about sort of plate spinning and portfolio career and how I ended up at alternative finance. It's directly relevant because actually 4 or 5 years ago I got more and more interested in alternative assets and alternative ways of putting together funds, and I got really interested in exchange traded funds, ETFs, because I thought there was a potentially disruptive model, and we'll come back to disruption as well later, which could blow away the old asset management.
Well, it's very interesting because I was in a breakout group and Greg Manuel, who's the editor of the London Financial News, precisely raised that point, that there are American discount warehouses selling ETFs for next to no fees, and how can you disrupt it? There ain't much fat to be taken out of those.
In fact, no fees. In fact, Charles Schwab has got a whole platform called One ETF with zero.
How can you disrupt an industry that isn't ripping off its clients?
And in fact, what's so fascinating about the ETF model, which I originally got interested in, I was trying to work out how to do a kind of better version of Nutmeg, but I think Nutmeg's done a good job of what they've done, is how do you give investors the choice in a kind of zero-bound world? What I mean by zero-bound is rates are zero-bound. How do you give investors a better choice than effectively go to the wealth managers and the hedge funds I talked a bit about earlier, who will fundamentally capture most of the excess return from their clever strategies? And I thought ETFs was the way forward. But the problem with ETFs, though, is it's still, by and large, managed by the same old big corporations that are the traditional asset managers. And, I'm not on this program going to busily, besmirch the likes of BlackRock. I mean, they're great, very well-run organisation and they own iShares. But it's hardly that alternative up, in my argument now. It's become quite mainstream. And that's sort of how I, via a bunch of other kind of alternative things, I got interested in everything from catastrophe bonds to death bonds. There's millions and millions of things out there that are alternative, none of which work very well, rocked up at alternative finance.
No, indeed. Well, you interrupted my moan, which will actually explain why all this doesn't work in the first place, which is that at this conference a couple of weeks ago, somebody used a phrase which is like fingernails on a blackboard to me, of modern portfolio theory. And this used to do my head in the 1980s, because modern portfolio theory came about in the 1950s. Very few people have done as I did, which is read the original paper. The original paper said, this is a ridiculously simple model which probably doesn't apply, and here's 100 caveats. Putting those to one side, yada, yada, yada. Notwithstanding which, that you get the sort of bullshit marketing spin about in search of alpha and all this kind of stuff. And as we know, all the evidence shows that 98% of fund managers reliably underperform the index. And I think, coming on to the alternative finance sector, I think it's very simple, which is that in a world, certainly on all the traded public stocks where everyone's got the same information, it's very easy to delude yourself that you're superior to me and you can read the FT and gain more out of it whether BP is going to outperform Shell than I can. But actually, we've got a tiny amount of information about hugely complex systems like BP and Shell. Even if you're on the board of BP and Shell, you don't know what's going on in the whole bloody thing.
It's interesting, just I'll pick you up on that one. Actually, one of the most interesting pieces of research I've seen done recently is that a bunch of academics have looked at the crowdsourcing of earnings estimates.
I know some firms that do that kind of stuff.
Absolutely, and in fact, what is quite accurate, and it'll be relevant to what we'll talk a bit about it.
When you say a bunch of experts, these aren't sort of PR people who are sort of putting up this spin.
A bunch of academics looked at the crowdsourcing of earnings estimates. So what they did was they big sample sizes of people who could effectively guesstimate, or maybe knew, who knows, what the earnings estimate for companies were. And they found out that the crowd's estimate of likely earnings of big companies was actually, in many respects, more accurate than the paid analysts. And what I think that tells you is that, oddly enough, although you're quite right, in very transparent equity markets, it's very difficult to sort of wager and gain them on because there's all that transparent information out there. Quite often that information is not put in the aggregate, not put in the round. People don't step back from it and go, actually, this information doesn't make sense. And the crowd, paradoxically, is very good at that because the crowd sometimes gets things right. The experts get it wrong.
It depends what you mean by crowd. If you take a sort of bunch of folks in Malawi, they're probably not going to be a very good crowd. So, like all these studies, you've got to look at who's been selected. And I think the other point, which is a huge distortion, is, of course, the research analyst can't piss off corporate finance by saying your OPFI earnings this year are going to be rubbish.
Yeah, exactly. Funny that.
So there's a big distortion. Now, going on to the alternative finance, against the context you mentioned of all these various backgrounds.
Newfangled alternative ideas.
Newfangled alternative ideas. How do you think alternative finance, and you're one of the experts, if not the expert in London, given that you run all these conferences and you've got this best news site around on this, so you see all the information. How do you think it is the same, and how do you think it might be different from previous alternative asset classes, which, as you say, most of haven't actually worked out very well? What's the similarities and differences of the big picture? What are the data showing us?
Okay, so let's just step back. I think one thing that's interesting that's going on at the moment is that I think I would say that many of the other things that I've looked at have been insurgent asset classes or alternative asset classes. They've emerged out of nowhere. No one knew you could invest in these things, really. A classic, easy to understand example of that would be gold. We've always known you could buy a gold coin, but as an investable thing, it's actually, until fairly recently, been quite difficult to invest in it. You could buy your gold bar and stick it in a vault. That's not really a great investment portfolio solution, really. And then ETFs and ETCs came along, and you could buy a piece of paper that allowed you to access this investable asset, and it turned into an asset class. And now no one would think twice about having 1, 2, 3, 4% of their diversified portfolio of assets in gold, for instance. Yep, some people have a lot more, some people have zero. So it's become an asset class. And in fact, the reason it's become very successful as an asset class, for right or wrong, is it's fungible. It's quite easy to trade in. You can pick up a phone, you can buy stuff.
It's a liquid market.
It's a liquid market with fairly conventional standards about allocation and holding and how it's done, all that kind of stuff, yeah? You've got fiduciary requirements, you've got secondary markets, all the kind of stuff that you and I have been looking at financial services for years understand. So that's an example of a quite good alternative asset class. It's not been a particularly good investment in the last few years, but none of us would think twice about saying that gold and some commodities are an alternative way of getting exposure to different investments. So what's interesting about alternative finance is I started covering it really from the early days when Zopa was out, probably in the late part of the last decade. And it sounded an interesting idea, but it sounded fundamentally like just a new product and a few interesting providers. And it's metamorphosized in the last couple of years into an asset class.
And how do you differentiate between the word product and the word asset class?
Because an asset class is more than just a product, yeah. An asset class is a series of characteristics and variables within it, which an investor finds useful, yeah. So there's transparency in there, it might have a yield in there, so you're an old fixed income trader, reason why fixed income securities are bonds used is because they have a dependable yield, don't they? Yeah. And you can thus model numbers off the back of it, can't you? And you also know that there are a series of standards about the credit worthiness of that underlying issuer. Yeah, and you can test the underlying issuer.
So it's a bit like the independent ISA example that the industry is pushing for. An independent ISA, so you'll have stocks and shares ISAs, but you'll also have a P2P ISA, at which point it's really an asset class because it's a section of your portfolio.
Yeah. And effectively, what you will do, to go back to my earlier example, is you'll just go, well, you know what, I've got a diversified portfolio, so I think I might have 1 or 2% in alternative finance. Yeah. And that's what I think is really interesting. What's happened in the last few years, it's turned from being an interesting series of isolated products and small niches, really, which is a peer-to-peer loans, which has turned into marketplace lending. You've seen crowdfunding equity emerge, and you've seen other niches emerge within there as well. You had kind of online trade finance and what Market Invoice does and that kind of stuff. And they're coalescing effectively around what I effectively call an asset class that gives you with the exception of crowdfunding equity, yield-like characteristics. So if I were to use a term, it's part of a broader alternative credit asset class. And you and I know that in alternative credit, there's probably a lot more than just alternative finance, because there's other stuff that's lurking around on the fringes of alternative finance, things like equipment finance or asset-backed finance. There's bridging loans, all that kind of stuff. And they've always existed for the last 5 or 10 years. There's these tiny little pools and niches. And it's coalescing around this alternative credit spectrum. And alternative finance probably sits slap bang in the middle of that spectrum, because alternative finance allows people to do mainly, I'm excluding crowdfunding equity here because it's a separate characteristic, gives you yield characteristics using the platform's own analysis of risk, which I'm sure we'll talk a bit about. And that gives you transferability, liquidity, and allows you to put it within your portfolio of diversified assets. And at that point, it becomes an asset class. And that's certainly the way the institutional investors are looking at the asset class.
That's a very good, coherent description of asset class. And in terms of what is required in alternative finance to become an asset class, you mentioned the very key word liquidity there. Now, I think that's one of the biggest challenges it has at the moment.
Yes.
And it's not liquid.
No.
And I think that...
By and large, not liquid.
If you and I were to go away and form a business where the gap is in alternative finance at the moment, I think it would be, coming back to some of these classes you mentioned in the past, a secondary market, just in the way that a secondary market appeared for what it was, these life insurance policies or all that kind of stuff. You know, I'll give you 80 cents on the dollar for that. Because if you look at all of the P2P sites, they say that you can get out of your asset if they've still got an inflow of money. And again, once you've been around a bit, the money comes in, the money goes out, the tide comes in, the tide goes out. So there are going to be times when you can't get your money out. So if you've got a secondary market, then I can see it's an asset class. Before that, I'm not even sure it's an asset in some cases, because if you go to the platforms who are lending to consumers, you don't even know the name of the person you've lent to. And it can be hidden behind provision funds and all sorts of things like that. It's the opposite of gold in that context. Gold is gold.
Both you and I also know that in our many years of experience of dealing with finance, the clever derivatives sods who work at very big investment banks have been very clever at putting together a gaggle of assets, sticking them in a form of a security, and then issuing a derivative off the back of it. And you probably have virtually no idea quite often what's the underlier.
Exactly. And the pattern from that is that, once again, they've lined their pockets very well.
Yeah, very well.
They've used their intelligence basically to rip off the public, who end up getting screwed. So, I mean, that's the trouble with that precedent.
So I agree with you on the secondary market. And for instance, one of the businesses that I've always liked the most, the rise of private secondary markets. I mean, Asset Management in that space, and there's a few people in that space. And I've always liked them because I think that the next big thing is going to be secondary markets. I completely agree with you.
So if I've got something with Zopa and they won't buy it back from me today because of whatever, I sell it to them.
Yeah, and then all this kind of stuff is emerging now. So that's absolutely one characteristic of what we need for the asset class to emerge. There's a few other things, and I think they're all looked at by, for instance, alt-fi data. Look at them all. Is that you not only need secondary market, you need sufficient flow. And that, in simple language, means volume. And the problem is, again, being brutally honest, there is basically a long tail of platform providers who really don't have very much flow at all. We get terribly excited about them and alt-fi write about them, but actually, when you dig at the numbers, there's very little, low millions have been transacted. Yeah. And you and I both know that, frankly, for anything really to classify as an investment, really, you're going to be talking tens or hundreds of millions of pounds, because that's at the point institutions start taking a notice. And I know people go, it's bad that institutions are coming in, they're muscling out the private investor, but the private investor needs institutions, because institutions create the liquidity and it creates the conditionality around the investments that actually allow private investors to feel happy and satisfied that they're investing in something an institution would.
As long as, I agree, as long as the institutions and the private investors, and this is a separate topic on its own, are treated pari passu, fairly and equally. Now, in crowdfunding and in P2P, some places do, some places don't, and some places a little bit in the middle. And generally, the institution won't negotiate for itself worse terms than Joe Public gets.
But that process will at least be out at some point, and we will force, if the investors don't, the regulators will, you'll force a much more pari passu approach. Better to have, though, that dynamic going on than the institutions not being there at all, and you get a random series of private investors who frankly don't know very much when it comes to the more complicated stuff, and there's no forcing of standards.
I think the other way of looking at it, which is what Rupert said last autumn, which is that he saw alternative finance as being just the latest way to channel excess liquidity or excess funds from one place to a deficit in another. And if you look at where the assets are in the world, well, most assets are owned by institutions anyway.
Yeah, but it's our money, it's our savings money, it's our retirement money, fundamentally.
So legally it is, in practice.
We've been looking at alt-fi data at the volume for quite a while now, and the good news there, my colleague Sam Griffiths on alt-fi data always loves showing my hyperbolic graph, as I like to call it, which is usually that curve that starts low and then just goes exponential. And it really has in the UK gone absolutely exponential. And the growth rates are quite extraordinary. So you're seeing quite a lot of platforms running at 10 or 20% growth rates a month. Now, I know that's all great for copy and all that data and everything, but it does matter for everybody, because once we start having platforms clear past the £1 billion mark, that will make a huge difference to the industry. It simply gives you the ability to set up a secondary market, gives you liquidity, gives you all the things you need. So the thing that struck me is that exponential growth, really, in the volume of transactions going across the platform. And that surely is a sign of the asset class maturing.
So that's the sign that the industry is growing very rapidly. What, again, you'll have seen this before, but what we will find out in a few years was to the extent to which quantity was a trade-off for quality. Have they kept the same asset quality going up, or is it chasing volume? Because whenever banks have chased volume in the past, it's always been a bloody disaster, because the only way you can chase the volume is by lowering your quality threshold.
Absolutely, yes. Look, I think it would be disingenuous of absolutely anyone to argue that once you massively, exponentially increase something, you don't probably take on some extra risk. Anybody who argues that is just fooling themselves. Of course you include the risk, but I think there is evidence. So one way of looking at this is returns. One way. It's not the only way. It's not the only way. Before we turned the microphones on, we were just talking off the record about risk, and risk is measured in many, many different ways. I'm sure we'll come back to it. But returns is not a bad way of measuring risk. And what we have managed to do with the Larry index.
And Larry, for the people who haven't heard of Larry?
That's the Liberum Alt-Fi Data Returns Index.
So for people who don't know, these are the various indices that they have.
So what Larry looks at is it looks at granular loan book data, from the top 3 platforms. And it breaks it down loan by loan, and it looks at the cash flows associated with the loans. And it looks at returns really over quite a long period of time, as long as SOPA's been going around, which is quite a long time now.
Which is effectively metaphorically equivalent to the FTSE indices.
Exactly that. And what's quite interesting is that there has been a kind of remarkable consistency of that returns data. Admittedly, and you and I both owed investment hacks and experienced investment commentators through one cycle. I don't dispute that, because we really are only looking at a period from about 2007, 2008 onwards. So I'm not going to maintain that this is a kind of econometrically valid sample size.
Past is not always a guide to the future.
Yes, absolutely. But it has been consistent, and it has been consistent around a 5% return on average.
And given that bank rates are whatever 0.5%, so there is risk in the sector, of course, but given that so far it's been relatively low risk, you've got quite a buffer in there.
Yeah. Well, if we look at the SOPA numbers back in 2008, 2009,
they had a positive return.
They were reasonably decent numbers, even through one of the
worst ever since the 30s or something.
Actually, now we don't know. None of us know when the next recession will happen, and none of us know what will happen to the default levels of all the major platforms. And I don't know. My guess is they'll go up by a factor. But very interesting, just coming back to what that factor is, at that event that you were talking about at our summit back in February, a really interesting piece of work done by one of the big credit rating agencies, and they looked at SME lending. So not in alternative finance, just generally SME lending. And what was really interesting is that I'd gone into thinking that actually in the next recession, default levels, for instance, would go up by a multiple of 4 or 5 times. Because I look at it, you ex-fixed income man, I look at the way corporate bonds work. And in corporate bonds, from trough to peak, you tend to be looking at a 4 to 5 times increase. The credit rating agencies are only looking at 1.5 times actual default increase levels. And I think that's really interesting. We might actually only see a 1 or 2 times increase in default levels. Maybe we'll see a 4 or 5 times. It may not be as big as we think.
Yes, weighing my risk, I'm a huge sceptic of all these models. I mean, I'm much more with Keynes, as I mentioned before, who said the future is unknowable. We could get run over this afternoon. Yep. Who knows? I mean, a lot of people sort of talk a lot, and a lot of people come up with numbers, but we don't actually know. And I think the biggest risk going forward, as you say, it's been very good historically. As I mentioned before, I would definitely be happy putting a chunk of my money with the leading platforms at the moment. And the risk going forward is that, frankly, they'll be doing something different in 5 years' time from what they did 5 years ago when we know it's going to be true.
There'll be separate things they invest in. So, in 3 or 4 years' time, they could all be investing in student finance or student loans. Yeah. Who knows?
Exactly. So you always need to be keeping on the case. So before we move on, what are the other characteristics you think that are important in terms of alternative finance as an asset class? You mentioned the returns. We could talk forever about the risks in it. It's a separate conversation almost. And we've talked about liquidity.
I think the other thing which I think is really, really important is that actually looking at the durability and the robustness of the platforms themselves. Because it seems to me that if you want to look at any investment, you've got to know that the counterparties, and there are various counterparties that sit at all investments, So in bonds, it's a very simple counterparty. It's the person who issues the bond, But in the case of platforms, you've got to look at the robustness of the platforms and how they're growing. And one of the things I've been particularly interested in is in the last 6 months, we've seen an absolute kind of tidal wave of platforms raising their own money. Big fundraisers. talk about IPOs in America. I don't know what lending club is at the moment, 9 billion, I guess.
And we've got IPO envy going on over here.
IPO envy, absolutely. How big's the size of your IPO? And I think that's interesting because I think it's relevant because although on one level, particularly I'm an old equity investor, one slightly sneers at all these people getting very excited about IPOs, and I think, oh God, nothing good will ever come of that.
It's a rite of passage.
It's about the maturity of the industry. And we do need some of these platforms now to be public. And the reason we need these platforms to be public, if nothing else, is because the mainstream equity markets will force transparency and disclosure on all the platforms. Because effectively, Lending Club in America, it always has been very transparent anyway, but it's having to disclose a lot more now because it was a publicly listed company, although oddly enough, not necessarily the same frequency. So that's a separate question. But transparency is forced on people by public markets, and I think the public markets will be an excellent thing for the industry. And I think actually where transparency is really, really, really needed is less in the peer-to-peer sector, where I do think, by and large, the peer-to-peer platforms are pretty good on disclosure and transparency, I think, to be fair. And crowdfunding equity, I think it's shocking.
It's a disaster.
It's a disaster.
As we're recording this one today, last Thursday, the episode with Gonzalo from Syndicate Room came out, and as we're discussing, he's just raised his $1 million plus in several days.
1.2 million in a few days.
And I think they've got a brilliant business model in terms of angel-led equity crowdfunding, which really not solve, but goes a long way towards improving valuation and due diligence issues, which other platforms don't. So he's got a very good model indeed. And he was talking about the fact that as an insider, as a chief executive and founder of one of these businesses, he thought it was quite outrageous that there was no statistics at all.
No.
And actually we did talk about alt-fi data then. There's no statistics at all, even on how many deals the platforms have done, or what percentage of the deals that the platform listed got funded. The most basic stuff isn't there.
And that, simply from an old-fashioned equity investor's point of view, is simply not good enough. It's just not good enough.
So where do you see standards coming from in that kind of industry? Because that's what I was concerned.
Well, I mean, I would hope that the industry associations, the industry bodies force it on them, but I don't think there's any evidence of that happening.
Having spoken to one of those associations not too long ago, they didn't really seem to think it was their job. Now there's a regulator there, they're waiting for the regulatory...
I think the regulator might, actually.
Well, the regulator might, but you know what regulators are like. They issue some consultation period for 6 months.
And then we wait for it to happen for another year and a half.
Exactly, and then the horse bolts down the lane, broke its leg.
I suppose the other way it could come from the client. So, for instance, we have another business that looks at giving good editorial education information for SMEs. So, classically, a good example is if I'm an SME and I'm a relatively early stage SME and I want to raise crowdfunding equity for my business, one of the demands that I might insist upon my platform is I'd like to know how much money you've raised, because if I'm going to go and be your client on the crowdfunding equity platform, I want to know that you've raised 10, 20, 30 million, because otherwise I won't come to you. So I think one of the areas where it could come from is it could come from the clients turning around, and we're trying to push for this on our SME facing website, say, look, you, the business owners, you've got to force the platforms to say, I want you to disclose what your transaction flow and all the other deal related flow information, and then I can make a proper distinction and proper judgment call about whether I'm going to use your platform versus that platform.
Yes, it's very interesting because it occurs to me the other direction it could come from is from new competition. So going back to P2P world, Landbay, for example, were the first people to publish what the borrower is actually paying.
It's all a very interesting loan book. I'd love to have a good look down their loan book where all those properties are.
Right. I haven't looked at the properties, but you've got a good example there, which is that the new people attacking the Citadel, the new people attacking the Citadel, do something which then sets a standard for everybody else. And you could do the same thing in crowdfunding. Now, the problem with that is that you run into the classic problem, which is that everything in the world tends to go towards being an oligopoly these days.
Yes.
In terms of asset acquisition, that's pretty much how much marketing and boots on the ground or computers you can actually throw at it. That tends to come from how much funding you raise, which tends to come whether you're first in the game.
But it doesn't necessarily.
It doesn't necessarily, but going back to the data that I last saw before Christmas, the P2P industry is pretty consolidated in the UK. It's going to be very hard, I think, to imagine, a new entrant into the top 3 in the next 12 months, for example.
Although the American example shows us where that might come, because it will come from new niches. So, if 3 or 5 years ago I'd have said to you, Mike, that actually, Lending Club and Prosper are going to be challenged by SoFi, a student lender, you and I would have laughed and no, it's an interesting idea, but it won't take off.
The difference in America is that firstly, America's a vast economy.
Yes, it is.
And secondly, for a whole bunch of reasons, it's a separate conversation, they've had a very limited number of players.
Yes.
In the UK, we're a much smaller economy, and there's 150 P2Ps.
Yes, although, actually, in many respects, the reverse is also true.
Well, we're bigger than America.
Yeah. I have my political dream.
We used to be, but then they've taken our empire away.
I know. Something about Balesity. But what I'm trying to get at, in the UK, we have a very small number of banks. So actually, the disruptive potential of finance in the UK is absolutely huge, because we've had a stranglehold of a very small number of financial institutions that have dominated money flows, whereas in America, they've always had vastly distributed money flows. And what's emerged from that is vastly differing numbers of business models. And what's so interesting about the UK model is that when the wall breaks and the big domination of the big 5, 6, 7, 8 institutions outside the banking and building societies breaks because the disruption is so intense, actually, you could see people emerging left, right and centre all over the place with interesting business models. And that's where the UK could actually leapfrog ahead of the Americans.
That's a very bullish statement. It remains to be seen. I mean, I think in the whole sort of tech scene in general, but certainly in fintech, the world is divided into two sets of people. I'm in the camp which says that innovation, just based on my observation of the past decades, innovation happens in a certain window and lots of exciting stuff happens and it all calms down and goes really boring for a while. There's another set of people who say, oh, the new innovation will build on the old innovation, the new innovation will build on that. And it's just like mushroom clouding up and we don't know. So, just wrapping up this section, David, any final thing you want to say in terms of asset class and alternative finance?
Yeah, I think that we probably will be, when we have ISAs coming in at some point this year, next year, whenever it is, that I think it's not impossible that your average relatively sophisticated private investors, I'm not talking your absolute mainstream investor, so you're not your cash ISA crowd.
People like yourself, David.
No, I wouldn't dare to put myself in that category. But you know, your average person who's got maybe more than 20,000 quid sitting around in their ISA, but who's got some stocks and shares and bonds. I don't think it would be unusual within about 2 or 3 years' time that those kind of people could be having a 1 to 5% portfolio exposure to alternative finance.
Absolutely.
And that's a big bloody number, Mike. That's a huge number. So although you said earlier that there may only be 2 or 3, I think the cake's going to be big enough for a lot more than that with many more niches. So that, for me, is the big transformation. If we could get to 5 or 10, even 10% portfolio exposure across the piece for alternative finance, particularly yield-orientated or venture capital-based finance, that could make a big difference.
I agree. And for the industry to do that, then they should read the article that I just written for you guys this week on risk debt in P2P, where I'm comparing it with tech debt. Tech debt is something that's known to startups and VCs in that basically you start with an Excel spreadsheet and string and sellotape and then try and upgrade your systems as the business grows. And I think that all the P2Ps have done that. I think they've done it much less in terms of risk because they don't have so much FS background. As we've discussed before with Nigel Verdon, the P2P, FX, B2B, the business-to-business FX, has got much stronger culture of risk because they've dealt much more with financial services, and I think the lending and borrowing is lagging. That's another story. I'll put a link in the show notes to it. So moving forwards, David, in terms of the sort of all your various interests and all that and waving the flag for some of these things, this Journal of Disruptive Finance, what's that about then?
Well, partly it's based upon what we were talking a bit about earlier. You yourself mentioned a bit about how technology disrupts. Is it in a short burst, short window of opportunity, or does it layer upon kind of a sediment of technology innovation? I am quite interested in that, partly because I am a bit of a pointy-head nerd. We thought actually that the whole area of disruptive finance, which is alternative finance, fintech, cryptocurrencies, all the way to online wealth management, you know, we talked a bit about ETFs earlier on and Nutmeg. They're very disruptive, you know, non-bank models. And I'm really fascinated by this. And I actually want to understand how the change happens, what effect does it have on the wider economy. I'm really interested, you know, all this money going into SME finance, would it make a difference to the macroeconomic structure of the UK? And the problem is, it seems that there's loads of spurious surveys done, no doubt by us and by the platforms, alleging all sorts of things about the effect of it, yeah? But it needs proper rigorous academic and industry practitioner research. And so really about 2 or 3 months ago, I sat down with Richard Swart, who's a professor over at University of California, Berkeley, and we're setting up the Journal of Disruptive Finance to exactly look at how fintech, alternative finance, is disrupting the existing financial services business and do really proper cutting-edge academic research by academics and industry practitioners about what's going on. And, you know, this is a proper peer-reviewed journal, and it's about turning all the discrete areas of disruptive finance that you talk a lot about into mainstream categories subject to the same rigorous research that every other form of investment and finance is subject to. And so we can possibly turn around and answer your question, is disruption within finance episodic, or is it actually kind of prolonged? And that's what we're doing. And that's literally coming out. We're doing a call for papers now, and that's coming out towards the end of the year. And the only other thing I've mentioned, which is very relevant to what we talked about earlier, is that AltFi, we're launching our own investor-facing news service, so AltFi Investor, which we will be getting you to write a column for.
Oh, excellent. I'll edit this nicely to make you sound intelligent and wise, David. It's
Yeah,
going to be quite a hard task,
difficult,
but
yeah.
never mind.
And we are actually going to try and answer some of the questions that you've already asked, which is about risk, about return, about looking at the whole alternative finance as an asset class. And we are going to try and look at it in a very rigorous fashion, analysis and data-led.
Interesting, and I'm very grateful to your editor, Ryan, who does such a good job on AltFi News. I had a coffee with him before Christmas, and he was saying, would I like to write something? And I was banging on about, I think business development is quite interesting. And he persuaded me away from talking about business development development to talking about risk, which I'd rather sort of set to one side for some time, because risk has become this bureaucratic box-ticking exercise and nobody really sort of thinks about risk per se in the way that it was originally thought about. And it's been a voyage of discovery for me. So in writing these 8 articles about risk in alternative finance, just by writing the articles, it became clear to me that the Achilles heel of the whole thing, which may or may not be a coincidence in terms of what you're doing, or you guys may have been driven by this or parallel thinking, is that perhaps surprise, surprise, or not as the case may be, the big gap in the whole thing is that both in crowdfunding and in peer-to-peer, they are not, surprisingly, putting all the focus on the investors. Investors could do with much better information about what's going on. That's the weakness. They're putting a lot of time and money into asset growth, into acquiring deals and all that kind of stuff. Yeah, origination. Stuff that's literally in it for them, because they can multiply that by valuation on the way out.
Because they're platforms and they deal with networking and origination.
Well, the trouble with P2P is it does imply as a model on your left hand and on your right hand. But actually, all of the alternative finance sector has, understandably, focused on the right hand, on the asset side, and far less in terms of the investor side. So who's actually out there standing up for the investor? Well, I think, the average intelligent investor does things like read all the columns in all these organs that you write for and tries to work it out for themselves. So I think there's a gap on that side.
And that's why, just to finish off it, going back full circle to the asset class, it needs to be looked at as an asset class alongside other asset classes. So the reason why alternative finance needs to be seen part of the sort of alternative credit spectrum, for instance, is I can then sit it down next door to a series of other asset classes and measure its risk characteristics, return characteristics. Same with crowdfunding equity. Crowdfunding equity is nothing more than a subset of venture capital, and nothing wrong with venture capital, great business model. But I can take venture capital metrics, as an asset class investor, and I can say, no, I like that more, I like this more. I think crowdfunding equity's got much more potential for this, but I might say that venture capital or traditional venture capital based around IP spin-outs and that kind of stuff might be more interesting. And that's why looking at it as an asset class is so important, because you can then stack it up against other asset classes and realise from an investor's point of view what it's really worth. So just to finish off, classic example is, you mentioned land bay a bit earlier. I've just written an article for Money Week about it, and I think it's a really interesting thing doing about buy-to-let mortgages, that kind of stuff. And if my memory serves me right, their classic 3-year product at the moment is about 4.5%. On the 3-year gilts, you get 1%. So you're taking a 3.5% boost over gilts, 3-year gilts. Gilts, the government won't default. The buy-to-let landlords could default. Is that 3.5% extra yield
adequate?
Yes. So rather than look at it as, actually, with Lambay I get 4.5, and with Rate Setter I get 5.1, and Zopa I get 4, blah, 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 whatever the thing is, Actually, no. Let's look at Lambay's characteristics, for instance, and I'm not saying it's right or wrong. I'm just saying, if you look at the yield characteristics from an asset class point of view, are you being rewarded for the level of risk?
No, it's interesting, because I think that sort of story wraps it up for me, because at the beginning I was rather feeling that, whether it's an asset class or not is a kind of linguistic thing, but I think I'm persuaded by your thesis, David, which is that it's not. It has a lot of practical implications, and I can certainly see from the perspective of an investor. If you're an investor, there's a big need for information. Let's say, for example, you want to invest into Southeast Asian equity markets. Well, you need to know something about Southeast Asian equity markets, or you want to invest in gilts, or you want to invest in alternative finance and the various segments within that, because it's becoming increasingly heterogeneous. So thank you for that, David. You've persuaded me of something which is sort of fairly unique, actually, and I'm glad to have a professional journalist on the show. I'm in awe of your magnificence.
I'm equally in awe of yours as well, Michael.
I'm also waiting for that cheque that you were going to send me.
Yeah, was it £2.50?
It was in the post, you said, right?
Yeah.
Good. Thanks for that, David.
Pleasure.
Thanks for listening. If you enjoyed the show, please subscribe on iTunes or your podcast app, or sign up at londonfintechpodcast.com for email alerts of new episodes. Live long and prosper.
We could sit in a bender all day, watching the firelight dance, watching the firelight dance. We could walk in the mountains before dawn, watching a happy moon ride, watching a happy moon ride. Come away from the city, with the tarmac so dead and the people so sad. Come away from the city, with the faces so grey, with the pain with the mountains and the trees. Can you see what I mean? Can you see what I mean? When we fade in between the earth and the sky, kiss the city goodbye, wave the city goodbye, wave the city goodbye, wave the city goodbye. Watch the firelight dance with me, 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 watch the firelight dance.